Yes, guys and girls, welcome. So, as a part of my Insta, we're just going to have a brief look at euro, dollar, and gold. So, firstly, obviously, I'm using the TradingView app. My TradingView is still down, so please bear with me when I change screens, because we're obviously going to look at fundamentals and we can go from there. So, euro, dollar. So, I've actually been short euro, dollar. My thesis has been short since about roughly about August. So pretty much when we had a huge shift in market outlook on a Fed policy during June's FOMC. So obviously the dot plot came out pretty negative, pretty more hawkish. And that was pretty positive for the US dollar. And I think that's what really started, the dollar king that we're seeing nowadays. So I'm still bearish, put it that way. I'm still bearish. We got the Euro ECB, who very recently, of course, has a lot of worries with COVID and the new Omicron variant. This, in short, pretty much just causes speculation and unease in the economy. Potential lockdowns. We have Austria, who's already gone into lockdown. We have potentially Germany. Next year we have political tail risk. And with the elections, and this, of course, as we all know, traders buy the rumor and sell the fact. So in this sense, of course, they'll be selling the rumor that this political headwind that is coming next year, is going to cause a lot of weakness in the euro. Pretty much what we saw with pound. When Brexit came out, and that caused political uncertainty and worry. And we saw a huge sell-off in the pound for a good few years. So, that's what we expect for the euro dollar at the moment in the future. So as traders, you should be forecasting what you expect in the future or what events is going to cause some issues. So pretty much what we expect with the pound, I'll give you a pound example, and obviously you can translate into other currencies. So with the pound, myself and Drew, probably right at the end of August, we was telling people to keep an eye on the potential headwind with Article 16 and the Northern Ireland trade deal for the UK. So obviously that is now in the forefront of uncertainty politically, and that is waning on the upside on the pound. So any movements personally is just going to be short-lived unless we see any sort of major sell-off in the US dollar, which we don't expect yet. We still forecast selling pound, which I already covered already. So with the euro, the main things are, of course, as of present, is the Omicron virus, and that's causing uncertainty with monetary policy. ECB actually becoming much more dovish in their stance, becoming much more, let's say, accommodative, because they're just uncertain with what's going to happen in the future. And obviously, you want to be investing into currencies or buying currencies where you have very strong, robust growth, very strong, hawkish or more hawkish, shall we say, central bank, fiscal policy, that's pretty decent. We don't want it too tight. We don't want it too tight fiscal policy, because that could actually negatively impact our currency. But in this sense, we want, strong monetary policy, robust growth. We actually want inflation to be running hotter than usual, because this just means the central bank has to step forward more quickly. And as a result, currency traders or bond traders on the front end will actually be buying up and pricing rate hike. And we will see stronger currency prevail. That being, that means the dollar. So pretty much what I just explained was the US dollar. And the US dollar should remain king for quite a while. We have the virus actually spreading around. Euro especially, we understand DXY is pretty much mostly priced against dollar. So if I invert it, and if it does it on the app, there we go. So to invert it, it's just option and I. So this I'm on Mac, so it's option and I. So hold option down and just press I, and it does that. So of course that's euro dollar right now. This is DXY. So firstly, you have to understand you're trading euro dollar. So you firstly have to look at what the euro's policy or fundamentals are. The growth isn't great. We have, political uncertainty in the future. We have virus that's spreading quite fast, potential Germany going into lockdown. This means ECB can remain much more accommodative, add more stimulus, add more liquidity into the system. And, you know, simple economics tells you that if there's more supply in the market, you generally see lower prices. And it's pretty much the same with the currency. So most of the time, you know, it's not a one-for-one correlation all the time. So, you know, those are the main things at the moment that we have to be careful of within the Eurozone. Low growth, or growth that isn't up to scratch, policy that's looking to become much more accommodative. You know, we have high gas prices, high oil prices. Europe, or the Eurozone, being a very big importer of these commodities, it's just adding much more negative stance on their trade balance. Drew loves to look at trade balance, so he's the one to speak to on that sense. You know, this is adding much, you know, not a good sign for the euro. So first you have to look at the fundamentals for euro. So the euro, let's have a look. So this wasn't exactly where we was looking to sell. I was just telling you, if it came into an area, you wait for a lower time break of structure to pretty much just confirm that it is going to, or it's highly likely to be moving away from in that area. Of course, you know, you can never be 100% in trading. You just have to work with the probability. So obviously, if we came into this area again, you know, or any area really, you just drop to lower time frame. If you don't want to be a bit more risky on the sell, drop to lower time frame and wait for a break of structure there, just to confirm that that area is the correct area. Similar in this sense, we marked out this area here. It popped into that area. If you didn't want to be a bit more, you know, aggressive on that move, because that is a very bullish candle on the daily, especially, you know, wait for that break. It broke below all this structure here, this higher low. Of course, if we go down like 1 hour, you can see it a lot better. You know, higher low, higher high, higher low, because it's still higher than that. Made the higher high, broke through the structure, made the pullback in the lower time frame, and then sold off. That's what you should be doing. Anyway, let's not move on to technicals. So, you know, we're still bearish. The euro, put it that way. We're looking just to sell on any pullback. So now you understand the fundamentals of the euro showing, you know, what I pretty much just said. Now you look at the US dollar. So what's the US dollar saying? So we understand the US dollar being pretty much bullish since August. You know, if you're bullish the dollar, you tend to be bearish the euro dollar as well, because obviously we understand it's pretty much inverted. So, you know, you now understand what the fundamentals are with the Eurozone, now what the fundamentals are with the dollar. So the dollar has very robust growth. If I just show you on Safari quickly, let me just get this up. Where are we? There we go. So we're going trading economics, a pretty much a free site, just to give you a good idea of what to look at. So on here, so you go trading economics, go to forecasting countries, and then choose what you want. So let's just briefly look at what the euro area is saying. So, you know, inflation's running hot. So we ideally want the ECB to be stepping forward to try and cap inflation. But they aren't actually going to do that, because they want to be seeing that growth. And with Omicron, it's actually clouding the judgment, or clouding the economic growth within the Eurozone. And, you know, that's causing some uncertainty in that sense. And therefore, you know, when we have a lot of policy meetings in around December, middle of December, I think it is, we got BOE, the Fed, and the ECB. ECB is largely expected to remain accommodative, especially during this Omicron virus. We have the pound, who's technically looking to hike, but a lot of traders, you know, or traders I've spoken to, don't expect them to actually hike, which is interesting. And of course, the Fed will have a little bit more an update on their tapering process. They're expected to actually taper faster than what they previously said. It's fairly hawkish, and it seems to be largely priced in already. So just be wary of that. So, you know, inflation's running hot in the Eurozone. So firstly, look at that. So we understand that the inflation is running hot. What's the GDP? So the GDP is, you know, actually stagnant. So obviously expanded, which we want it to be doing. It went from negative to positive. So it's gone expanded, but then it's plateaued. So you don't really want to be hiking or pushing higher on rates during a time of, or dialing back on stimulus, during a time of slowed growth. So that's a red flag, firstly. I'm just showing the real basics at the moment. Unemployment rates. What's the unemployment rate saying? So it's lowering, which is exactly what we want to be seeing. But how does that, you know, compare on a historical stance? It's getting close to pre-pandemic levels, which obviously is a positive sign. You know, unemployment rate tends to fall each month, but sometimes there's nuances within the type of data. And that's why when sometimes you see unemployment rate, fall, but then the currency actually weakens. Might be nuanced data within that. You'd have to look into it more at the time of release. Let's quickly look at the actual nuanced data within the Euro's unemployment. So let's look at employed persons. So how's that doing? So let's have a brief look. So it's actually increasing, but how does that actually, show on a historical stance? It's still below pandemic levels. If you look at a Canadian dollar, I'm not going to show it now just because we're covering the euro and I don't want to drag this on for too long. But just look at Canadian dollar. Their employment actually gone past pre-pandemic levels and it's expanding. And this is why, we're being pretty much bullish the Canadian dollar for God knows how long. So, that's the first thing you look at. What's the unemployment rate? What's the unemployed persons? Let's have a brief look at that. Okay, still, nowhere near pre-pandemic levels. Actually, it is around pre-pandemic levels now. So obviously that's great. That's what we want to be seeing. Let's have a brief look at unemployment rate. Sorry, let me just quickly look. Okay, cool. It's getting better. But then boom, obviously that expanded well up. Everyone getting, furloughed and in the Eurozone. I'm not sure if they had any type of stimulus. But nonetheless, look at the labor market. So first you look at what's the inflation rate. So inflation, is running hot. Technically, just based on that, you could have a little bit of a bullish sentiment on the currency, just because you understand that, the central bank will have to be sounding more hawkish to battle market forces. And it's in this sense, it's just not happening. Purely based on the fact that the Eurozone's just isn't expanding at the rate that it should be. We have Omicron virus. So firstly, look at what's happening in the Eurozone, fundamentally in terms of data. So we understand employment's not great. Employed persons and the nuanced data within that just isn't expanding or getting better at the rate it should be. Then understand, okay, that's our sentiment in that front. Is there any kind of third-party headwinds, i.e. higher gas prices, which harms the economy? COVID in this sense, or in the last 2 years, it's been COVID. Next year it's going to be, I don't know, it could be something else. Don't know, war maybe, another virus, who knows? Okay, great. What's the political uncertainties now? So political uncertainties right now, it's not too much political. It's just more, of a central bank stance. In the fact of, when I say political, I mean the government pretty much. So political uncertainties, not at the moment, but we understand in the future there is going to be some political uncertainties, just based on the fact that there's going to be elections and potential issues that may cause. And typically investors don't want to be buying into an economy that isn't actually that has political uncertainty. So we understand that GDP isn't expanding in the Eurozone. Labor market isn't doing the best. It could be a lot better. Prices are very high in terms of inflation. You could look at all this interest and M1 and M2 money supply if you really wanted to. Right now, it's not really important. Government, you could look at this stuff. Debt, this is pretty high. It's pretty much globally anyway, so you don't really have to look at this stuff. Consumer sentiment, if you wanted to, not really of relevance right now. It is good to look at every now and again. But right now you have to understand that trading is always trading, so your style should always be trading. So right now it's more to do with COVID and ECB or central bank policy. So now that we understand that it's not really looking good for the Eurozone. So firstly, even without looking at a chart, you think, okay, my sentiment is bearish the euro. Then you do all the fundamentals with the dollar. Right now we're not going to go over it just because I'm a bit restricted for time. But to put it in its best sense, employment is very, very robust. GDP is pretty decent. We have inflation running hotter, above 6%. We have a Fed who's actually very hawkish in their language. They've already started to taper their assets, their QE. They're largely expected to, based on the front ends of the bond market, they're largely expected to hike next year, just after tapering ends, which is around June time. they're expected to hike interest rates. You know, if there's any sort of pushback against that, then we'll see some weakness in the dollar, but we aren't actually seeing that right now. And that's why, you know, we're seeing a huge amount of buying orders being flooded into the dollar. You know, we have EM markets aren't expanding at the rate that it should be. Of course, you know, when how strong the dollar is actually weaker, emerging markets, Eurozone's not doing too great. You know, all this sentiment is all pretty much bullish for the dollar. So now you think, okay, you pick the weak and you pick the strong. You don't want to be picking trades where there's weak and a weak economy. You know, you could trade it, but it's going to be very, very choppy. Liquidity might be thin. Fund managers and traders at banks want to be investing into currencies that show, you know, a weak and a strong, or a strong and a weak. You know, you don't want to be trading a strong and a strong. Typically, you'll see consolidation, some wicks, some volatility, and, you know, weak and weak is pretty much the same as a strong and strong. You know, low liquidity and a lot of spikes. So that's our thesis for the euro dollar. So we understand, if I just go back onto the app. So we understand, you know, euro dollar, just based on market sentiment, is very, very bearish. You know, we understand that there might be some potential technical pullbacks, i.e. profit taken, and we'll see higher prices. I don't know, it might take out liquidity at some point, some liquidity up there. So, you know, at some point that will be taken out. Don't see it moving up that high yet. Too much uncertainty with the euro, too much strong positivity coming out of the dollar. And right now, you know, we're personally selling on dips. You know, that's just our personal thesis. It's not financial advice, of course. This is just what our research has been doing, you know. So, you know, if this pulls back, would rather it pull back, to be honest, because we can sell at a higher price to push down again. You could look at options if you want to. So a large amount of expirations are around at a 111. So 111, you know, is pretty much just below this thing here. You know, some liquidity might be starting to take place. You know, retail traders buying this as a double bottom, and then eventually, boom, it's going to get taken out. You know, as it comes down to here, you might see some consolidation. Traders buying up as a triple bottom, and then boom, they get wicked out and then moves lower, of course. So that's just our thesis on the eurozone. Let me just briefly have a look at cool. So yeah, that's the euro and the dollar. So, you know, we're very bearish still. Just be careful of potential technical pullbacks, i.e. profit taken. So that's the euro dollar. Really nothing too much to be said on. I've pretty much covered it all. And then of course gold. So let's move on to gold. First is let's look at what the charts are saying at the moment. So gold. So our thesis was, you know, once the Fed starts becoming more hawkish, and, you know, they show their hand a bit, we are actually bearish gold. So that actually was shown in this sense here, and they stepped forward and became pretty hawkish. And then look what happens with gold. So typically gold has actually been rising because of inflation fears, and recently Omicron. So, you know, first it was eyes on about 1850, which I think was about the imbalance point here, or I was eyes on around the imbalance. But then it just completely tanked through. I didn't sell it, but it completely tanked through. You know, we want confirmations in trading. We don't just trade based off emotion. So typically all this buying pretty much down from here has been because of inflation fears. And, you know, if you follow trades or inflation hedges, gold is typically seen as an inflation hedge. So during times of higher inflation, you know, asset managers and traders and pension funds, etc., they buy gold as a hedge against inflation. And of course, recently we saw very high, especially since our 6% inflation print that came out in the US, gold was absolutely flying, and rightly so. You know, rightly so. But then the Fed actually stepped forward and showed their hand and said, you know what, we're actually looking to taper, and we're actually looking to hike rates. You know, or they weren't actually physically saying that. They weren't pushing back on market pricing. And that was the main thing that traders were looking at, is what does the Fed say in terms of market pricing? And they typically didn't actually say anything about it. We had the RBA who actually pushed back on market pricing, and we saw a big slump in the Australian dollar. So that's our thesis of why the buying orders came flooding in. So if I just quickly, let me just move this. If I just quickly show you. So typically, if you saw this, you'd think, why is gold rallying? So, do your research, watch Bloomberg TV, whatever your personal thesis is, do your personal research. So you think, okay, well, inflation came out at 6.2%. I think it was 6.4. I don't know. I can't remember off the top of my head, but it's above 6%, put it that way. And that's a big milestone for it to push through. And traders, I think, wow, okay, inflation's running hot. We don't have a Fed who's becoming hawkish quicker. So we're going to buy gold as a hedge against that. And we saw a huge rally. But then, that's when you watch the Fed meetings and see what's being said. And then you'd see Fed chair pretty much step forward and didn't push back on market pricing, had a very hawkish tone at the time of the meeting. And look what happened with gold. Gold completely slumped. So our thesis was, we wanted the Fed to show their hand. And we continually said it for the last couple of months on gold to our members. We want the Fed to show their hand first before we look to get in the trades. Well, I know Drew sold it here. If you want to look at it from a technical stance, it's probably creating divergence there. Don't treat divergence too much. There was some slight divergence in the RSI. If you look at that, don't look at it a lot. But if you look at it, that would be a tell sign. Breaks of structure above these higher lows here. So that's boom. Wait for the pullback into an order block and sell off. So now, now that the Fed is actually showing their hands much more aggressively, we largely expect gold to continue slumping, unless we see any developments from Omicron, like much worse. Because right now it's seen as mild symptoms and it's pretty spreadable. That can be easily countered. But if it's really aggressive and very dangerous, you would see gold absolutely rally hard. So just be very vigilant of the virus and see, because it's early days yet. It could get a lot worse. And this is why you need to be cautious in your trades at the moment, because liquidity might be thin. So liquidity might be thin in the FX markets, might be thin in the equity, just because traders are unsure with what the current environment is with the virus. And of course, that's going to show its hand in the next couple of weeks. Once more data comes out, any more deaths, any more hospitalizations, or any more cases coming out. And, we might see a rally in gold on the back of that. But if the Fed continues to become more hawkish in their language, especially after December 16th, I think, or the mid-December meeting, we continue to expect to gold to become very bearish. Bond yields completely flying up. Year-end on bond yields are actually 199 or 1.99% on the 10-year, which is, we've got a bit of a distance to move from now. So let's have a proof. Where is it on here? What do I have it? There we go. So bond yields largely expected to push into about 199 by year end. That's a lot of movement, but I think it all depends on the Fed. We've seen it rally really hard over a mere couple of weeks. So anything can happen. But, if the Fed continues to show their hands, it becomes much more dovish. We'd expect bond yields to continue to rise. But it all depends, I think, right now on the Omicron virus and any potential, headwinds that may cause. So in terms of gold, if it continues to push down, which it's largely expected to, and, COVID or the Omicron variants remains subdued and not a lot of issues, we would largely expect it to push below here and into about 1650 to 1600 is where we're personally aiming for, before we can, of course, reevaluate, because that's pretty cheap levels then to be buying gold. Because just think about it from a basic fundamental perspective, low demand, low supply, very high demand. So even just based on that, you want to be buying gold. But of course, it's very tied to the US dollar. So you also need to look at what the fundamentals behind the dollar. Fed become more hawkish, looking to taper quicker, looking to hike rates quicker, not push back on market pricing, all very negative for gold. But then if we have a very huge development from the virus, now you understand what you want to be doing with gold. So if it's still expecting it to remain bearish, and we largely expect it to push into at 1650 to 1600, a double bottom there, triple bottom. Once we get into here, traders will be buying it as a quadruple bottom or whatever they do. We might see a little pop up higher, suck in more retail traders, and then boom, it pops down and below that, which obviously is good for us. because we will be selling gold anyway. So any pullbacks really is we're selling on pullbacks. This is just our personal thesis. Of course, if you have your own reasonings for buying gold, please go with your own reasonings, because at some point I'm going to be wrong, and or I will be wrong, shall I say, and this could be the wrong trade, so have your personal thesis, and then just use us as a proxy. Like when we read the fundamental documents, we do our fundamental thesis first, and then we look at the documents just to see if we've missed anything, something we've just forgotten about. I think, okay, is that going to change our thesis? Probably not. Is it going to change it in the short term? Might cause some short-term weakness. Good opportunity for us to buy something, So yeah, I think that's it for today. If you want to see anything more, please let me know. I didn't want to go over too much fundamentals just because there's a lot of cloudiness in the markets at the moment. I just wanted to tell you how it is right now. But if you have any questions, please let us know. So I think that's it for today, guys. Take care.